So the way I look at the hedge venture is, you have to look from the top down hedging, bottom up hedging, operational hedging, and leveraging a lot of financial engineering or terms. So there are a couple of things like example. Traditional venture capital, they normally like to write a big check so that at the get-go, they get 20% of the companies, right? Because, coming from the hedge fund, I do think that that's not the way, the right way looking from the risk standpoint. One thing different between the public market and the private market is in the public market, you can have a lot of information. You can go to read your 10K, 10Q, listening to analysts. In the private market, especially in the early stage, you don't have a lot of information, right? So that's risky. And the only way to buy that risk is to be involved, to be with the company for a long time, understanding the gap or the help that you can provide to the company. So at Field Venture, we do phase investing, right? We write a small check so that we can become an insider. We can, helping you with what you need. And in the meantime, we build a conviction. So we don't just flip through the deck and then make a big decision, but we do diligence after we go inside. And we, identify the key KPI that the company needs to achieve for every single financing round. And if they achieve it, and if we help them to achieve it, we will continue to build out our position. That's a part of hedging too. You build out your position over the long term so that you can reduce, the downside risk. Instead of making an investment, and if the thesis, doesn't happen, you just have to write it off.